Wonderful, wonderful. So, good afternoon, everybody. Thank you for joining our webinar this afternoon. It is always an honor and a privilege to see the fantastic turnout that we have in every single one of our webinars. So, thank you so much on behalf of the entire team. My name is Laura Nieves. I am Director of Investor Relations here at Astor Realty Capital. Tonight, we are very excited to introduce our new investment opportunity, 2795 Fulton Street in Brooklyn, New York. This is a 51-unit ground-up affordable rental preferred equity investment. We are very, very excited about this project. It mirrors the success of our recent Atlantic Avenue development, which was in fact oversubscribed by $2 million within just 48 hours. And we are anticipating a very similar response for this particular opportunity. And for good reason. It is a 36-month preferred equity investment. It offers quarterly distributions, and it has projected returns of 16.3% to 18% IRR for accredited investors. A few of the investment highlights before we do a deep dive today. Our partner in this deal is a highly established Brooklyn developer. They have over 25 years of experience and 1.5 billion, yes, I said billion, in completed projects. Astor, we have a 5-year track record with this partner, with this developer. We have completed 6 investments and multiple exits with Southside units to date. As I said, it's a 36-month investment. There is a possible 6-month extension, bringing it to 42. One of the major attributes is that we have a principal guarantee. So the developer is personally guaranteeing Astor's principal, unheard of in today's market. And it also is a state-sponsored affordable rental housing program. So this is part of the New York City initiative, underscoring the importance of affordable housing in today's market. So before we jump in, I just also want to take a second and talk about some major market news that happened this week. The Federal Reserve cut interest rates. So right now, we are seeing a pivotal moment for real estate investors. By the Fed cutting rates, it lowers borrowing costs, which will boost profitability for developers. And as capital markets recalibrate, real estate values are expected to rise. This shift creates a very small window of opportunity for investors to lock in favorable returns, especially in these high demand sectors like multifamily. Now is the time to act and take advantage of these market conditions before competition increases and returns will decrease. So before I hand it over to the team, I'll do a very short introduction on Astor for anybody who doesn't know us. We are an institutionally backed private equity firm. We are led by seasoned professionals and we have tested market cycle strategies. We invest smart capital into high quality real estate and ventures with relatively short durations. We aim to grow and preserve our partners' investments. We currently participate in a 4.1 million square feet portfolio worth $2.7 billion in 12 major US submarkets. We constantly, over the last 10 years, have been achieving returns for our investors that surpass industry averages. And today I am honored to introduce the driving force behind Astor, which is Joe Berko. Joe is our CEO and founder. He has 25 years of experience in real estate. Under Joe's leadership, Astor, we have become a forerunner of the private equity industry. Joe's innovative deal structures and strategies have earned him notable awards over the course of his career, which include Power Broker by CoStar and New York Signature Broker by Globe Street. Also joining us today is Andrew Milbank. Andrew is our Chief Investment Officer. Andrew is instrumental in shaping Astor's investment strategies. He ensures that we continue delivering strong, consistent returns for our investors. His deep expertise is crucial to identifying the best opportunities that we present to you guys, our investors. And we also have Alex Mokry, our Senior Analyst, who will be presenting the deal tonight. So on that note, without further ado, I am going to pass it over to Joe, Andrew, and Alex, and they are going to be sharing more details about the opportunity. As always, please, we encourage a collaborative session. Use the chat feature, use the Q&A. Your questions will be addressed during the webinar, and we look forward to hearing them.
Fulton Street, preferred equity. 16 to 18% distributed quarterly with a phenomenal developer, and on top of it, a personal guarantee. A very, very meaning piece of document that says in the worst of the worst should happen, your principal amount is personally guaranteed. So we're very happy to share with you our latest investment with Southside Units. This is a project in Brooklyn. It's our sixth project together that we're doing with probably one of the most active, maybe one of the strongest developer in Brooklyn, New York. A group that is highly, highly focused on building multifamily just in the borough of Brooklyn, never built anywhere else, always going after multifamily and maybe a little bit of a mixed use. And for the last several projects, we've had the benefit of enjoying a 35-year tax abatement, a very rare commodity today, because the tax abatement, it's called 421A, is expired some 3 years ago, some 2 years ago, and there's nowhere to recreate it. Now, future programs may come about, but it's not going to be as strong. They're not going to offer 35-year tax abatement. So this is sort of like an anomaly that we're able to participate and offer you, the investors, outsized returns with a lot of structure around it in order to present you with tremendous opportunity right here in Brooklyn. And so I'd like to share with you really the idea of what this project is about. I hope you'll get as excited as we are to do our next project together with Southside Units. So here at 2795 Fulton Street in Brooklyn, we're talking about a 51-unit ground-up multifamily with 1,200 square feet of retail on Fulton Street, a couple of short blocks away from the entrance to the subway. The location is located in a blue-collar neighborhood called Broadway Junction. We'll talk more about the neighborhood, but effectively we are in a large subway hub and a large transportation hub. that is causing a lot of new development because the area is considered a lot more affordable. We'll talk more about the affordability crisis that's happening in New York. Right now, the city is running at a 1.4% vacancy factor, which means that if you're looking for an apartment in New York, good luck. You're not going to find it. Whatever you will find, it's going to be extremely expensive. After it's coming in with 6.7 million, our developing partner is coming with 2.9 million. A very nice substance between us. We'll have about 68%, just shy of 70% of the project holdings. And this is going to be a project that we're very proud to do because it also helps the Strap City that is going through this tremendous affordability crisis. Why do we love this project? Again, these are outsized returns. We're enjoying the fact that interest rate is still very high. Even though the Feds have reduced rates recently, we're still pushing to get high returns to our investors. I suspect and I believe that things will change in the coming months as interest rates start coming down. So will be our ability to offer you those type of returns. So to lock in a 16.3 to an 18% net return to you, the investor, is going to be a moment in time, and I don't know how many projects will be able to offer this. I suspect this might be our last project with this type of high returns under a preferred equity position. This is a highly experienced developer, which is extremely important to us. Over 25 years, close to 30 years in this market, builds around 85, 90 different apartment buildings. Very capable group, very high trust in terms of their ability to execute. This is an ongoing partnership that we have going on 4 months now, 4 or 5 years now. This is project number 6. So we have the experience. We know how these guys work. It gives us a lot of level of comfort. We're achieving very high yields. I'm talking about 9.5%. And our stabilized value will be at a 62% last dollars between the bank loan and our last dollar preferred equity position. Short duration, 36 months, again, out of which you're getting your quarterly distribution with 1 + 6 months extension. The developer, as I mentioned earlier, is personally guaranteeing our principal amount, which is a very big deal. We'll talk more about it. And the state of New York is now offering this affordable program and are guaranteeing the rent to the tune of 90% of the rent is guaranteed by the city of New York. The rest, the small difference, is guaranteed. Essentially, it's not guaranteed, but the small difference is coming from the inhabitants of those particular units. I'll bring the next page, project investor return, to you, Andrew, to discuss how we're breaking down the expenses and achieving those type of returns.
Okay, thank you, Joe. I appreciate that. So there's a lot of information here on the screen in front of you, but as Joe mentioned, we are offering returns of 16.3 to 18% net IRR. As you can see in the illustration here, this is quarterly payments, right? So we have quarterly cash flow with an annual catch-up. The developer is funding this himself from his portfolio. We will get to that in a little bit, right? So because this is a development project, there's no income during the project from the property. The developer has a substantial portfolio, nearly 100 assets within it, almost $2 billion in value. So we'll go into to what that means. We'll also touch a little bit about more on that, the personal guarantee that Joe mentioned. The returns are net of fees and promote to Astor. And on top of the net investment, right? So in a $100,000 example, the net investment is $96,500. That $3,500 per investor, or per $100,000 investor in this example, goes towards all of the things that Astor provides during the life of the project, right? So asset management, reporting, taxes, site visits, all the software and the systems that we have in place, etc. So that is the net investment, and that is what's returned at the end of the investment. You can see that on the screen here in the very last column, right? That's the net investment that is returned. We'll talk a little bit more about taxes, in the Q&A. But just so everyone is aware, there are 2 different strategies that we have, 2 different tax strategies that we have for this investment. For most investors and most US-based investors, you will have the ability to receive a K-1 that offers return of principal for the distributions up front, or as the cash flow comes in, with long-term capital gains at the end, right? This is typically the most advantageous for most investors and for US-based investors. Additionally, for foreign-based investors or anyone that wants more of interest income, potentially IRAs, things like that, there will be the ability to receive a 1099 from Astor that will count as interest income with principal at the end. So there are two different strategies here for that, and we found that investors like that ability, and it's very good for their kind of overall strategy as you're looking at your investments. Moving forward to the legal structure, one of the reasons, right, that Joe said, right, good risk-adjusted return. This is a project that has, we said, about 16 to 18% net IRR. We're also in that preferred equity position. We also have the personal guarantee, but adding on to all of that, the language within the agreement that we have with the developer is structured almost more like a loan than your typical preferred equity, right? So we have control over major decisions. If the developer were to say, I want to turn this into a retail or a hotel or anything like that, or wants to change the timeline to that, right? The budget, Astor retains the ability, the control over those decisions. We also have takeover provisions in the event that anything were to go wrong with the project. We are able to step in, figure out a solution with the developer, figure out a solution ourselves, or potentially bring in a separate party to finish the project and see it through to completion. We have capital call protection, so if there are cost overrun, the developer is required to fund that. We are not liable for the loan. Okay, we have stringent reporting requirements. We're in pretty regular conversation with the developer at this point, as many of you are aware. Multiple projects with them at this point, but at the same time, there are stringent reporting requirements that he is required to provide us all information, provide us access to the site, all that kind of fun stuff. And we have an alignment of interest, as Joe mentioned. There's just under $3 million coming from the developer himself. That is not so typical in today's environment, at least on a project like this, where the developer is bringing such a large chunk of equity. It's also directly equity from his own pocket, right? So when we say GP equity, sometimes that could mean a mix of the GP, the developer, plus their own investors. That's not the case here, right? The money is all from the developer himself, and that is all subordinate to Astor's principal and Astor's return, right? So we have a significant alignment of interest for the developer to finish the project, see it through to completion, and deliver our return to us. Joe, I will hand it back to you to talk a little bit more about the property itself and the business plan.
Thank you. And so a little bit about the property itself. Again, this is a mixed use, 51 units, and we have about 1,500 square feet of retail and very busy strip on Fulton, right across from the elevator tracks, close to the major transportation. Broadway Junction, it's a blue-collar neighborhood that is attracting a lot of development because it offers affordability and all sorts of other bonuses and benefits to build in this particular area. It's not a sexy area. It's not an expensive area. It's not where you go to a club. It's not where you'll have the best lounges or the best cuisines to pick from. But it is a great working class neighborhood in the heart of Brooklyn. We're also getting a 421A program. This is a 35-year tax abatement, which really freezes the taxes for the next 25 years at its same level. So it's a significant savings, which translates to tons of value. And only in the last 10 years, after 25 years, only in the last 10 years, the tax starts slowly phase out, and the abatement starts phasing out, and the full tax is impacted. Again, we are looking at this project as a short term. We're here for the construction. We're here for the heavy lift. We're getting our nice returns, and then we exit. So we don't stay in these programs long term. The leasing strategy, as I mentioned before, we're going with the NYC HRA City Phelps program. It's a city program that is essentially designed to help families that are falling on hard times, to move them away from homeless shelters and undesirable locations, and to put them into something that looks like, just like this picture here, just like this visual here. Which is basically a Class A apartment, small, cozy, however, extremely safe, clean, and tidy. And so, we're very happy to do this. The current partners that we have, this is the fourth project, I believe, or the fifth project that he's doing for this particular program. And so he's familiarized himself with this. In fact, the first time he did this program, we've done it to talk about it in a moment or so. And this is essentially what we're looking at. This is going to be a short-term project. And as I mentioned before, we're going to probably have a rollover option, but the project is well underway. Let me just share with you some of the visuals from the project right now. This is currently how it looks as of September. We're already out of the ground and the project is far advanced. And so the way this developer works is he locates a piece of property, does his research, does his studies, acquires it all cash, goes into the ground, gets the permits, obviously, gets everything approved, goes into the ground, starts with his piling, obtain his 421A program, which, by the way, is the program itself is over now. Talking about new programs, but this has been a grandfathered site. So he gets his 35-year tax abatement. And when everything has been done, which takes about a year, sometimes 14 months, sometimes even a little bit more, when everything is done, we make two phone calls. One phone call out to the bank, hey, I'm looking to refinance. I'm looking for a construction loan. I need $17 million, as in the case over here. And I'm looking for a partner. We get the phone call. We're lucky to get the phone call. I have to say, it's a wonderful structure and wonderful developer and a great partner. So we're lucky to get the phone call, and then we work out our details. We do our due diligence. Takes a couple of months on our side to finish the due diligence, and then we go into this project. But the developer constantly continues working it with his own capital. By the time that we show up, we probably have about a year left on this project until we reach stabilization, maybe 14 months, and then we'll either roll it out or opt out of this program and basically collect our capital and our returns back. And so this is really sort of like how things are working. This is a project that we've done together. It's 2700 Atlantic Avenue. It's about 4 or 5 blocks away from the subject site. Right now, it's a larger building that we've completed with the developer with 227 units. The first project we've done together. It's a little bit of an interesting story. We started our relationship in the summer of 2020, middle of the pandemic. The world was very, very different. The developer came to us like many other developers who were looking for capital. There was no capital out there. We're able to negotiate tremendous terms. We, in fact, arranged for about close to $40 million for this particular project. You can only imagine in the middle of the pandemic. But something else has happened. A level of trust has been created between ourselves and the developer. And also, we were able to negotiate very, very strong terms that we are still enjoying their benefits today, including the personal guarantees and including other factors that are very important to us. Over here, you're going to see a timeline. If you're going to be part of this investment, like many of you here on this call, you know that you get quarterly, not just quarterly distributions, but you also get a quarterly report from us, letting you know what's the status of the project, how things are progressing, if there's any delays, if there's any issues, or if we reached a certain milestone, such as topping off, or maybe we've got certificate of occupancy. You're getting all of this as going on. But this is essentially the high level. We'll start from October. This is when we're looking to close. And then we're looking into Q3, possibly Q4 of 2027, out of which you're going to get your quarterly distribution along the way. Again, I mentioned before, the city is, I might even say, somewhat self-induced type of a crisis, an affordability crisis right now. It has since 1968, the city have not seen a vacancy factor that is so low, 1.4% vacancy factor. In other words, it's impossible to find an apartment in the city. And if you find an apartment already, you're paying through the nose. You're paying extremely high rents, as much as $140, $150 in some of our existing projects in Brooklyn. Insane amount of dollars. And so to combat this, the city is now trying to put together as many programs as possible, increasing FAR in order to fight this tremendous crisis. It's going to take a while. It's going to take a good number of years. before the city will be able to find any sort of normal stabilization. The fact that interest rates are super high and people are not looking to buy right now, there's less demand for purchasing condominiums and homes, also does not help. And so we are here and we're offering to the city really a beautiful, affordable project, especially going for needy family affordable situation that is quite unique. So we love it because we also get to do really great. The neighborhood itself is called Broadway Junction. It's part of Cypress Hill. It's the kind of like call it the transportation hub, the transportation center of anywhere between East New York, Cypress Hill, blue collar area. It wasn't an area that was getting a lot of attention for many years. It was mainly a lot of older buildings, some repair shops, some auto mechanics, and that sort of a thing. It really wasn't something special, but because of its sort of like a big center hub, and because of a comprehensive rezoning that has happened some 10 years ago, the amount of affordable housing and amount of new construction that's coming to the area certainly have improved the area tremendously. And it's not uncommon to drive around the various blocks around this project and to see cranes and new development and a lot of new projects that are coming about. Because neighborhoods, other neighborhoods such as Williamsburg and other spots throughout Brooklyn has gotten extremely, extremely expensive. And now those areas, whether they are under certain programs or not, are considered to be affordable. And that's essentially what's needed over here. To talk a little bit more about the financials, I'll bring back the conversation to you, Andrew. So please take it from there.
Yep. So, the source and uses, the project budget, however you want to call it. I won't spend too much time here, but there is a senior loan that's already signed, that's in place. And then Astor's bringing the 6.7 million of preferred equity. The couple things to mention here, right? As I said before, the GP equity of just under $3 million. That is directly from the developer. That's all his own capital. So we do have an alignment of interest there. The project cost, right? The uses, we're very confident in these numbers. As Joe had mentioned earlier, the developer has anywhere 6, 8, 10 projects going at once. He's done a number of projects with this program in this area. We're very confident that he knows what he's doing with the costs, and these numbers really will not change. Regardless of that, we still do have the capital call provision protection. So if the project costs did go up, that's not something that affects us. That is on the developer to fill that gap. Moving on to the pro forma, a lot of numbers in here. One of the major ones, the 421A, you see that in the kind of upper middle there, expense ratio with the 421A. As Joe mentioned, this program did expire in June of 2022. The project is grandfathered in as part of due diligence with the seller. Our developing partner drove piles into the ground, started the foundation. We have proof of this in the due diligence Dropbox for anyone that wants to view it. But this qualifies us for the 421A program. This is not something that newer projects, newer developments can take advantage of. There are other programs out there now, but they're not nearly as advantageous as this one. And that's one of the reasons that this project is so attractive, right? An 8.5% yield to cost is very, very high. Most new developments are 6.5% to 7%. If you have a very good project, right? So you have a substantial bump there on the yield to cost, and that yield to preferred equity, 9.5%. If the worst came and Astor were to take over this project, we would be in at a 9.5% yield, which again, very, very strong here. So to talk a little bit more about the rents, we'll introduce Alex. Alex will talk on the city program and kind of the program rent comps that we have from another project that the developer did that Joe mentioned earlier. Go ahead, Alex.
Thanks, Andrew. So yeah, as Andrew mentioned, I will talk a little bit about the unit mix now. As you can see here, we have a very heavy tilt towards larger units, 2 and 3 bedrooms, that make up about more than 90% of the overall unit mix. And that is because of that city program that was talked about in various stages of this presentation so far. The city program, and I will talk about this in a little bit also, is targeting families in distress, no matter what distress that is, financial, domestic abuse, any type of distress that you can think of. And contrary to what some would think is these are larger units. So these are not the studios in one bedroom. So that's the reason for the heavy tilt towards 2 and 3 bedrooms. We also have here, you can see the AMIs, so the area medium income for the unit mix. And the AMI is not for a specific borough within New York, it's for the entire city of New York. So that's just for the clarification here. So all of these rents that we are budgeting are tied to a specific AMI, and that specific AMI is set by the city of New York, not a specific borough within Brooklyn. Moving on to the explanation of this program again. So this is the City FEPS program. Essentially what this program does is it helps individuals and families move towards permanent housing again because they were in some type of distress. Again, this distress can be any type of distress, as mentioned earlier. And I think Andrew and Joe mentioned that we have about 80,000 people within this program, or just under 1% of the New York City population, which is a lot of people, and there's very limited space, as Joe also mentioned earlier. The vacancy is extremely low, so there's very high demand for this type of program. And the city typically pays a set amount of rent for each unit type. So it pays a certain amount for 1, 2, and 3 bedrooms. And typically the way that it's being paid is that 10% comes from the tenant and about 90% comes from the New York City government. So again, this is for the type of individuals and families that try to move again to permanent residency. You'll see here in the next slide that we have done a very similar project, and we are currently investing in one very similar project to this one. 2700 Atlantic was a project we have done, I think, about 2 years ago, and we've exited about a year ago with the same developer. And these rents are exactly what we're collecting currently by the AMI and the unit type, which you can see here. Yeah, and moving forward, we'll have Andrew talk about the developing partner.
Perfect. Thanks, Alex. So Joel Schwartz, Southside Units. Again, I won't spend too much time on this. We have some information in the Dropbox, and many of you might already be familiar. But some of the highlights on Joel and the company, right? 25 years of experience, and 25 years of experience building in Brooklyn. Right? Doesn't go really to Queens or Manhattan, New Jersey, Pennsylvania, right? He's focused in Brooklyn. That's where he's built his business. He holds most of his properties, right? So you'll see on the coming pages here, nearly $2 billion of value in properties that are in his portfolio, almost 1.5 billion of that being stable, occupied properties, cash flowing assets, right? That's what lends a lot of value to the personal guarantee that we have from him on this project, right? On other developers, you may see they're cash asset rich, cash poor, right? They may have a lot of assets, but they have small shares in those assets. They're not seeing a lot of income from that. That's the opposite with Joel here. He retains majority ownership on most of the properties and sees a substantial annual cash flow net to him from those assets. So that's what's giving a lot of value here. Their organization, as you can see from kind of the chart here, right? These are just a sampling of the individuals, but they are vertically integrated. They do everything in-house, from construction to leasing to financing, accounting, reporting, all that kind of stuff, right? That is done in-house. Okay, so that's a benefit. They're not outsourcing anything. They retain control and integrity over all of those processes. We've mentioned 2700 Atlantic as a previous project that we've done with Joel, 352 Meeker as well, 27-unit multifamily rental in Williamsburg. We have since exited that with Joel and went into a project in downtown Brooklyn, which we actually anticipate an exit of that in December of this year. You can see that on the next page here at 236 to 242 Gold Street. as well as 310 North 7th. That's a project that is just about to start development, and it's not on here, but 3051 Atlantic, very close here to 2795 Fulton. That is about to start construction. That is in the same type of program, the City FEPS program, as 2795 Fulton. I know this next page a little bit harder to read these, but the excerpt of this is available in the due diligence Dropbox in the sponsor bio. You can see here, right, about 1,500 units, right, of cash flowing properties, another 500 something in development, nearly $2 billion in value across the portfolio, and just about 1.1 billion in loans. So relatively low LTV portfolio wide. And you can see almost $75 million in NOI, 45 in debt payments, so nearly $30 million of cash flow, right? That's coming to Joel's portfolio, right? Which he is a substantial portion of that, right? Again, just lending a lot of viability and integrity to the personal guarantee that we have, and really just shows, right, like the exit for this project, right, is not for us to sell. Okay, he's going to refinance this. He might bring in another small investor, and he'll move on to the next one. So that's why this program that we have with him, with the rollover, where he completes 2795 Fulton, brings us to the next project. We're able to achieve very attractive returns, and we're able to achieve them over 36 to 42 month periods, as opposed to just saying, okay, we're in Fulton, he completes it, we exit, and now we have to try to redeploy that capital again. As interest rates are coming down, right, those returns might start to get lower. So, I think as Joe's mentioned a couple times in the various webinars and podcasts that he's on, right, we're at a moment in time here where we have a really, really strong risk-adjusted net return and a really, really strong sponsor that we've partnered with. So, Joe, I will turn it back to you to close us out and talk a little bit more about yourself and Astor and some of the accomplishments that we've had over the years.
Wonderful, wonderful. Thank you very much, Alex. Thank you very much, Andrew. So just to wrap it up, for those who are joining us first time, Astor Realty Capital, we are a national investment firm that specialize in real estate. Our capital is really across the stack. From inception, we have invested in various projects, and if you'll amass all of them together, you'll find over 4 million square feet of prime real estate across 12 major markets, 7 states, mark-to-market stabilized valuation over $2.7 billion. Our average return across all the investment or across all the capital stack, including first position mortgages, preferred equity positions, and common equity positions, hovers today around 23.6%. Not too shabby considering everything that this last 4 years have thrown at us, from pandemic to inflation to anything in the middle. No capital lost, thank God, until today. 36 different projects, no capital lost. I've been around the block for now going on 30 years. Since 1995, that's when I started in real estate. I've been an advisor for public companies, private companies. I've been advisor for the state of New York for about 9 years, nominated by the last 2 New York governors. And we've been doing a good amount of advisory work and brokerage work for many years. And around 2014, 2015, we pivoted and moved away from the advisory side into the investment side and started Astor Realty Capital. Andrew has been with me for now over 10 years. He's a principal of the firm. And Laura's been with us for over 10, 11 years. Many of you are familiar with Laura, also to become a principal of the firm. And so will Marika. We're a solid team. Alex has been with us for now over 6 years. A very solid team. We've been working together, and I think we're fantastic together. Some of the reasons of why to invest with Astor is that we provide you control rights, enhanced control rights. that are not always common in those type of syndications. The ability to step in, the ability to remove an operating partner, the ability to prevent any situation that capital call should be our business and not the business of the managing partner. All those things are not always common in the space of investments in real estate. Of course, then we're able to sometimes even offer extra things such as the personal guarantee. We do very heavy ongoing asset management. And so we're very much involved in the project, making sure that money, capital, time, everything is according to plan. And if it's not, then we address it. Our focus is always your preservation of capital. We look at multiple projects, over 700 projects a year. Many of them don't stand the test, that what if test, black swan type of a scenario. What if things go bad? What if things go sideways? Can we hold our investors' capital in our own? And if the answer is no, and unfortunately many times the answer is no, then we abort those projects. So 98% of all the projects that we review, that we give the time to, basically don't fall into the category of safe enough for us to pursue. And so we say no to. Alignment of interest. Andrew mentioned multiple times the alignment of interest of our operating partners, that making sure that they put capital into the deal, but there's also an alignment of interest with you, the investor, with us, the principal of the firms, the individuals that are running the show. We're also put our capital where our mouth is. We take the exact same risk. We are aligning our risk and we're aligning our rewards together with you. And we have unique access to opportunities. Essentially, we're in this market for many years. We're a vast network of brokers and connections and people that know us for many years. We say what we do, and so that essentially allows us to look at deals first without having to go through brokers and without having to go through all sorts of third-party mediators. A lot of our projects are, quite significantly are spread out in the strongest markets, and we're sort of like even concised our focus and let go of some of the markets that we've invested in the future. You can find a lot of that information on our brochures and in our information. Also, I'd like to invite you to what we call Glassdoor, which we do once a month, which allows you to understand how we review our assets, how we look at the market, how we analyze the market, how we analyze what's the next step for us in terms of investments, and also how we do our own internal asset management. With that in mind, I want to thank you all for participating with us, and we'll keep it now open to questions and answers. Thank you.
Wonderful, wonderful. So thank you so much, Andrew, Alex, and Joe, for spending the time on that detailed deep dive. I'm so sorry about the black box. I could not figure out what that was, so I apologize. But as you have been seeing in the comments, I have been dropping the link to our full investor portal software, which has, whenever there was a Dropbox mentioned, it was referring to our due diligence files. So you'll see that in there, our full investment OM, that you can see and review all of the slides and even more than what was presented in the presentation. I will now, Andrew and Joe have been doing a fantastic job at answering questions as they arose, but I will leave the opportunity now if anybody would like to ask a question, and Joe and Andrew can answer live. If anybody would like any further clarification on a question that has been asked to date, please take this opportunity now. Perhaps Joe, and before I quickly hand it over to you, I'm sorry, I know I've been talking a lot. I just want to confirm thank you to everyone. I've been getting your emails, I've been getting your text messages since this webinar has started. I'm confirming your commitments. At this point, I probably won't get back to you until first thing tomorrow morning, but I am receiving them. So thank you guys so much. Not surprised. This is getting very, very high interest from you all. So please don't wait. Express your interest to us. Joe, Andrew, Alex are here to answer any questions you may have to help you with your decision. So, anything you can expand on?
Yes, sure. First of all, thank you very much, Laura, and thank you everybody for participating. And again, my apologies for that gray section on the right bottom of the screen, and I think it was a little bit also blurry, so I promise that we'll look into that and make sure that we correct it. there's been a couple of questions that I want to address. One of them in regards to, what's the ratio? How can you make sure that tenants will actually pay their rent? Andrew answered it very nicely. This is a program that is 90% guaranteed by the city of New York. So in fact, if the rent was $4,000, $3,600 will come from the city of New York. The actual inhabitant will have to pay just a 10% balance. That's $400. And so the individuals are there to sort of like, reestablish their life, re-put their life back together. Is it possible that somebody's not going to pay their $400 share in a brand new apartment, 2-bedroom, 2-bath? Everything is possible. But like Andrew said, we have an 80,000 wait list. People are going through this lottery program to get one of those apartments. So, I want to address something that's very important. Our job is to analyze risk and to offer you the highest possible returns with the least amount of risk. And I think that this project and the line of projects that we started doing with Eastside, with these guys from Brooklyn, Joel Schwartz and the team, really represents that. And in the words of Blackstone, I think we're doing our best work over here. We've reduced the risk quite significantly. There's a personal guarantee. We keep on dancing around it, but it's a really big deal. It really shows the other side. It shows us the person that's taking our capital is fully responsible for it and will go as far as you can go and grab my house if I don't return your capital. That's sort of like a very significant, specifically in this market. The second thing is we're looking at, the supply demand drivers. We're looking at this complete dislocation of what's happening in the New York City market. Much of it is induced by policies that have been governed and have accentuated and pushed to this situation, not allowing the public sector and the private sector to interact in such a way that there's any sort of interest from the private sector to offer any form of affordability. So it's really now resting on the shoulders of the city and the state to come up with solutions. It's quite abnormal to look at a market that has less than 2% vacancy, right? It's quite abnormal. That means that something is off and rents are just going through the roof. I mentioned before in the presentation that some of our projects in Brooklyn are achieving $140 and $150 per square foot. I want you to imagine what it means. 1,000 square feet apartments, it's $12,000, $11,500. I mean, those are really abnormal numbers, and we're seeing them in all of the free market projects that we have. The other thing that's quite unique here is the tax abatement. I don't want to repeat what was said about it, but consider the following. The tax abatement has phased out in the middle of 2022. These projects, the one that we were able to put together with Joel Schwartz, these are all grandfathered in projects that the developer was able to acquire several years ago, put them under contract, close on some of them, most of them. Others, he basically went through the regulations, got himself the permits, all those good stuff. And so it brings tremendous value, right? I mean, I just want you to understand that when you finish a project in New York City or any major city, the biggest impact in terms of running expenses is always the real estate tax. Here, a real estate tax is assumed to be around $600,000. I think we're paying less than $40,000 a year in real estate tax. It's a significant difference, and that $600,000 a year or close to that amount, and multiply it by 25 years, and only after 25 years, right? That's significant distance that we're basically freezing the low real estate tax for a group of 20 for an amount of 25 years, and only then starts phasing it out. And so that also creates this type of projects to be some sort of an anomaly. And then lastly, we're all seeing it, right? Interest rates, it's starting to come down. Inflation, thank God, it's under check right now. It's under 2.5%. I drive by, I see the pumps every day. I see the differences. I think that we're pretty much looking at a drop of about 1% or 100 basis points within the next 6 months or less. The market is starting to wake up. Cost of capital and the availability of capital is going to become a lot more available, right? A lot more out there. Banks are starting to open up. Banks are starting to lend. We're seeing it. We're seeing the low interest rates starting to trickle. There's going to be a lot more activity, which ultimately will mean that we're not going to be able to deliver this type of returns. And our interest is to lock as many of those as possible. And I'm talking about, a handful of those, right? But still, as far as our concern, as many of those as possible in order to deliver to you a 16%, a 17% if you're in a different category, or an 18% if you're in a larger category. Those are quite unique. And our objective is to lock it in right now for the next 3 years. So we're excited. We feel really good about this developer, everything that he told us in the last 5 years, and the multiple projects that we've done together. He came through. Whenever we would argue, kind of like friendly arguments about how long will it take for this individual to finish a project, and we always take the longer approach. We always say, no, it's going to take you an extra 6 months. It's going to take you an extra 9 months. You're not going to achieve those rents. He always proved us wrong, and I'm happy for it. And so on this project, I don't know if it's going to be the last one that we're going to be able to put together in such a structure, because even when we do rollovers, the next project will have to have a 421A. I'm not sure which project he still has in the pipeline that still have 421As. I'm sure there's just a handful, if anything, left. And ultimately, he also has to feel comfortable with the type of very high interest rate that we're charging on our preferred equity. So I'd like for you all to take some time, review it. And obviously, we know there's going to be different opportunities coming in the future. But I think it is an anomaly in a moment in time. Other questions that came about was in regards to takeovers. Have we as a group have done a takeover, and what's the story with how do we address changes in budgets, and what's our responsibility as it comes down to cost overruns and so on, or capital calls. So, those of you that have been investing with us in the last 6, 7, 8 years know that our documents do not have any capital call provisions. In other words, if there is a deviation in the budget, ultimately, it's the responsibility of the sponsor. It's one of the things that we negotiate. Things can happen, right? Force majeure can happen. Higher interest rate that causes the project's budget to skew to some extent. Things do happen, right? But we always say that as long as it's not negligence, right? As long as it's not on the shoulders of, it's not caused by negligence or bad acts of our developing partners, then we do accept that, there's going to be some deviations. Those deviations, if you only did $1 million, a couple of $1 million, sometimes on very large projects, are the responsibility of our operating partners. This is why it's important for us to do business with operating partners that have not just the ability to execute, but also deep pockets to withstand changes in budget. And so this particular project is no different. If there is a change in budget, we don't have the upside here, but we're also not going to take any of the downside associated with it. So we have a good developer that knows how to cut a check and has the capacity and financial ability to do it. Over here on the right, you can find the full investment memo, all the due diligence, all the information. Laura, maybe you can open it and we can go through it very, very quickly to share with our participants here what sort of information they can find in the due diligence box.
Joe, while she's pulling that up, would you just talk very briefly? We had a couple questions on the fee. So, fee of 3.5% and kind of what that covers on the Astor side.
Sure. So, depends on which project we charge different fees. Typically, it's around 2%. Other times, it's a little bit lower than that. Then we take a little bit of an admin fee to cover the cost of legal, right? We file with the SEC on every project that we do. It's a full-fledged on documents and that gets designed according to how the SEC rules are. We also file in various states. We have investors from all across the United States. On each and every state, we file and we do that. There's cost to those things. Other than that, we have the legal cost for the negotiations, right? The project's negotiation, the operating agreement between us and the sponsors. So for that, we have a different set of attorneys, transactional attorneys. We have our team here. We do background searches. We do a number of different things. So that's for the administration side. As far as the work that we do, and over the course of the next 3 years, the team that you have here and many others that we are not here on this presentation are essentially working in order to make sure that project is on time, on budget. We report to you, we go to the site, we speak with the lenders, we look at the requisitions. We do all this extra work that needs to be done in order to ensure that everything is according to plan. And so that costs money, right? Our team, salaries, and keeping the lights on, as we call it, everything costs money. So everybody participates to a small extent. In this particular project, it's a 3-year project. So we're essentially taking 3% in the beginning plus some admin fee. And then we're taking a little portion, a small portion of your annual or quarterly distribution in order to keep the expenses. So this is essentially how it is. At the back end, we have a profit, right? We have a promote. We participate in your promote. So obviously, when we say, as an investor, if you're in a certain category or category core, which is the first category, essentially, when you're getting a 16.3 IRR, it's after our fees. Our fees have been calculated and deducted. And after the promote, it's been calculated and deducted. The absolute net amount that's being delivered to you on an annual basis is the amount that we're quoting. So if it's 16.3 to some categories, 17.2 to other categories, or full on 18%, these are all net of all of our fees and success and everything else. I see Laura is keep on referring to the investment is met with a huge amount of interest. So I can say the following. At the last investment that we've done, it was about a month and a half ago, 2 months ago. Also, we've negotiated the same deal. Same terms, exactly same terms, same sponsor, project almost identical. This is 51 units, the other one was 49 units. We met with, and God bless you all for it, we met with more than a $2 million oversubscribed request to participate, and we had to turn people down. Obviously, once we fill up the amount that we are committed, then it's done. I don't know if we're going to have another project like that. There's nothing in the works right now. So if you're interested, and this is what we tell everyone, if you're interested and you're capable and you want to do it, make a commitment. Obviously, it's a soft commitment, and I'll explain what a soft commitment is. Essentially, you're saying, listen, I want to put down $200,000, but I want my attorney to review the documents. I want to call my cousin who's in real estate in Brooklyn. I want to make sure I do a little bit of my own due diligence and go through it, but please count me in for $200,000. I'm an accredited investor, and we know that you're accredited, or you know, and we will verify and check. But it's very, very important because it's flying off the shelf. We have $6.7 million plus fees and everything comes out to about 6.9 that we're going to be raising. But once it's done, it's done. We already have a significant amount of commitments of several groups that are super excited about this, and for the right reasons, right? We've really created an amazing package here, and I think it's coming across. I'm really happy for it. So don't be shy. Don't wait to talk to your attorney who's showing up on Monday of next week and stuff like this. It's not going to happen. Most likely, we'll probably get oversubscribed quickly again, God willing. Take the bold step and shoot an email to Laura or to somebody else from the team and say, put me down for this amount. I'm good for this amount, and give me a couple of days. I need to take my time and I need to do my due diligence, and that's fair game. If at the end of your due diligence, you figure out that this is not a deal for you for any reason, okay, you have to give us a reason. You can give us a reason or not give us a reason. But for any reason, if it's not for you, no harm, no foul, right? But we want you to have a place if this is something that you find inspiring and you want to take part of this fantastic investments.
Absolutely. I second what Joe said. Just to reiterate one more time, this investment opportunity is available to accredited investors only. That is based on your net worth or 2 years of W-2 income. Before I can accept any funds or have any signed documents, I do need to have that verification from you. Happy to have a private conversation about the terms to ensure that you meet that. But a quick Google search will tell you if what the SEC requires, as that is an SEC requirement and not an Astor requirement. I will now, as Joe said, I'm just going to bring up our investor portal that you have been seeing me drop into the chat. This is our investor software that will have everything available to you. You can, of course, submit your interest via this portal, or you can reach me personally. I've dropped, majority of you know me, but I've dropped my information also into the chat. You will see down here that we have the investor due diligence. So when Andrew and Joe were referencing the Dropbox, you'll see that there. It will open up to those files. And then also the full OM that we had dropped here. If you do continue and to invest, you'll see over here that you'll continue through, and I'm of course here to support you in any way in regards to the portal. A little bit on.
We can take a minute and just go over some of the information for the diligence, what you'll find in the Dropbox.
Absolutely.
Yeah, so let's just go over this. Right. So, Andrew, maybe you want to say a couple of words. We don't have to go too deep into it, but certainly if you want to say a couple of words about the information that we have.
The folder for project information, right? That has the largest amount of data in it at this point. That's the offering memo. That's the Excel that we've done on the underwriting. That's site photos and permits that the developer has pulled, information on qualifying for that 421A tax abatement. As we continue through the legal process with the developer, you'll see more of the folders begin to be populated with title policy and title search, which they have from their initial closing at this point, right? That's the land acquisition and title folder. As the loan documents are available, we'll put them in the financing folder. Some people like to read through them. Some people, don't really care, but either way, all the information is there for you to review and make your own decision there. The personal guarantee exhibit is there from prior deals that we've done with Joel. I know there were several questions on the personal guarantee. I will take just a second here to kind of talk to that as well. And it ties into what Joe was talking about on the asset management side, right? Just because we're, September of 2024 and we're making this investment doesn't mean that our verification of the developer or the project end, right? So our first deal with Joel was back in 2021, right? That we closed it. We've done several deals with him since. We still do the full legal process. We still do all the full legal searches and updates. We re-verify and recheck his portfolio for that personal guarantee. So as recently as this week, right, the real estate schedule was updated, which you'll see in the due diligence folder. So that's not just one point in time that we look at that and then toss it in a folder and all right, we'll see in 3 years when the investment's over. We're constantly checking that and making sure that everything is in good shape. Right, that matters to us, as Joe's mentioned before. Right, we're aligned alongside you. My capital, Joe's capital, Laura's, Alex's, Marika's, our friends and family. Right, our capital is all in here. So it matters to us to make sure that those that those things are in a good shape. So we're constantly checking things like that. I do just want to address too, there's one more question that Joe had mentioned rolling over the investment into long-term equity. It just says anonymous. I'm not sure who asked that, but what the rollover structure means is that, right, Joel runs a well-oiled machine, right? Southside Units is a very good vertically integrated shop. They move very quickly on their projects. So when we look at something like 2795 Fulton Street, 16 to 18% IRR, we want to achieve that return for 3 or 4 years, not just the 12 to 15 months that it's going to take Joel to build and stabilize 2795 Fulton Street. So what we actually created is a unique structure that allows him to roll our equity to another asset. So once 2795 Fulton is built and stabilized, he will refinance, right? Bring new cash to that project and roll us to another investment, right? Which allows us to generate those returns for a longer period of time. And it doesn't, all the structure and the time that we spend on it is not just, 12 months and then, you have to redeploy the capital somewhere else. So there is additional projects, and we do get a 36 to 42 month investment. But just to answer that question clearly, that is not a long-term equity play. This would have a maximum term of 42 months, and a maximum of 3 projects within this overall investment, because anything that he rolls us into needs to have a clear exit within that 42-month period. He can't roll us to a new project in month 36 and expect us to say yes to that, right? We would decline that because there's not a clear path to an exit by the time that the 42 months is up.
Very great.
Thank you, Andrew. Okay, I think, Joe, before we wrap, I do want to just make one more comment. Right now, our lawyer is finalizing our investor subscription agreements. We anticipate having them by the end of this week. They will also be in the investor software for you to review very clearly. And as always, please reach me. I am here. I'm very responsive to anything that you may need.
So thank you very much, everyone, for joining. Thank you, Laura, Andrew, Alex, Marika, for being in the background, and looking forward for a successful investment together.